What's the difference between capitalism and socialism? In a nutshell, it's not about regulations versus deregulation. It has to do with who's being regulated. When legislation is brought before Congress, does that bill limit the citizens' rights, the government's authority, or big corporate America? We're going to examine this topic through the lens of insurance providers tonight on this episode of The First Branch. Tonight's episode is going to be a bit more lighthearted than previous episodes we've aired here on this channel. But it is still an important topic to examine from a fiscally responsible perspective. I mean, does the way in which our insurance companies charge us for coverage even pass the common sense test, much less the legality test? Is the management of insurance providers in this country grounded in moral uprightness, or are they just trying to scam us? I think this is a very important conversation to have, seeing how just about every American over the age of 16 is required to have some sort of insurance coverage in one way or another. So the way in which this industry is managed is pretty significant to the economy of the average American household. So how does an examination of the insurance industry here in America shine a light on whether or not we are being governed by socialism or capitalism? Well, that's a great question, and I am going to get to that answer here in just a minute. But before I do, please take some time to smash that subscribe button, tap that bell icon, and don't forget to click that thumbs up and like this episode to show your support for this channel. The way in which the insurance industry is regulated tells us a great deal about how our government is run. Do the current regulations favor the industry? Do those regulations restrict or limit the American citizen? And if so, does that prove regulations to be unconstitutional? Does the industry impose a greater burden to the individual citizen while alleviating the industry of any of the risk? If so, then does that prove an unfair advantage to the industry while the American citizen bears the burden of all the risk? Or what's more important is who should bear the burden of that risk in the first place? Now that may seem like a lot of questions to get through to get to an understanding of the insurance game. And I thought you said this was going to be a much more lighthearted episode there, McMurray. And it really is going to get a whole lot lighter throughout this episode, because it is the last question that I stated that is going to become the true focal point of understanding where the morality of these regulations truly lie. So for the sake of clarity, I'm going to ask that last question again. Who should bear the burden of the risk in the first place? To place this question in context, I'm going to start this discussion by telling a story. It is no secret to the fans of this show and to my friends and family, I'm the proud owner of a Piper Cherokee 6260. She's an absolutely fun plane to fly. I can load up my entire family and the world gets a whole lot smaller because what was once a weekend trip is now become an afternoon outing. And let's face it, it's just plain fun to go flying. See what I did there? Just plain fun? All right, I'll stop telling dad jokes. Well, for now at least. But back to the story. I bought the plane a little over 2 years ago. And prior to buying the plane, I had to have insurance on it. But before I could be insured, now keep in mind, I already paid the premium, which was a one lump sum payment for the entire year. I had some recency experience requirements I had to perform and then get signed off by a certified flight instructor in that class and category of airplane. And it's no big deal. That's just the price of doing business, so to speak, to fly airplanes. So I did what I had to do to be legal. Now fast forward 4 months, I had accumulated 24 hours of flight time and 15 landings. I was night current and had already done a long cross-country flight to Hope, Arkansas and back to clean in a day. It was a fun flight to support a family member and the nonprofit that they're involved with. From a legal standpoint, I was not a novice in this airplane, yet the insurance company was already charging me a higher premium than someone who had about 250 hours of flight time in the exact same airplane. Why? Because they already anticipated I was at greater risk to being in an accident than a pilot with more flight time. And that's no big deal, I get it. Less experience means greater risk. It makes perfect sense, right? Well, we'll see after we get done with this little story. So about 4 months after I bought the plane, I was flying a friend around the Temple, Waco, Killeen area to do some sightseeing and a chance to let him fly the airplane. Because if given a chance, who wouldn't want to fly an airplane, right? So as I'm landing, I begin to transition from the approach to the touchdown phase of flight. I rotate the nose about 5 feet higher than I should have. The airspeed dropped dramatically, and then bam, a hard landing. I knew immediately that I had damaged the landing gear. To what extent, I didn't know, but as I was taxiing to parking, I knew it wasn't good. However, after we shut the engine down and got out to inspect the damage, there didn't appear to be any structural issues with the wing spar, or the landing gear strut itself. The only one thing that was affected was the starboard landing gear, and it was just leaking hydraulic fluid and air. So I get on the phone and I call my insurance company, and they inform me that they'll cover the cost of the damage, and I was excited. A $500 deductible, and a few weeks later, and I would be back in the air. Well, the mechanic gave me a quote, and since the only thing that was damaged were the O-ring seals inside the strut, the cost was only going to be $600 to repair it. So I called the insurance company and I told them that I would pay for the repair myself, and they were cool with it. So they canceled the claim and I paid out of pocket for the repair. Then comes time to renew my insurance the following year. I get the paperwork and I see my premium has gone up $380. So I naturally call my insurance company and they say, well, Mr. McMurray, due to your claim on the collapsed landing gear, you have proven to be a greater risk, and that's why your premium has gone up. I'm sure you have already figured out what my response was. But you didn't even pay for the money against the claim. So how did I prove I'm at greater risk when that risk didn't cost you any money? Their response: well, you notified us of the issue, and it was clearly a performance-based event, and we have it recorded. So in order for us to continue coverage, we're going to have to increase your premium, Mr. McMurray. And so, because I want to fly, I opened up my wallet and I take it in the shorts. Now that I've provided a real-world story, I want to go back and revisit those two questions I posed early at the top of this episode. Does the industry impose a greater burden to the individual citizen while alleviating the industry of any risk? If so, then does that provide an unfair advantage to that industry while the American citizen bears the burden of all the risk? Now, while I have used an airplane example, I know tens of thousands of Americans can relate to this story, even in dealing with automobile insurance companies. So we know that the answer to these two questions are most certainly yes. Now one has to ask, is this law or the way they're doing business constitutional or legal? Well, yes, it is. There's nothing wrong. There's nothing prohibiting companies from making a profit. I mean, heck, I'm a capitalist. I'm all for the free market. But is this truly a free market when this is the practice of the entire industry? Absolutely not. So the answer then doesn't become a matter of regulation versus deregulation. It simply needs to focus on where the regulation should reside and still keep the market competitive. Because right now, it is the individual American policyholder that is getting screwed by insurance companies by allowing them to double dip on the risk associated with behavior that the government has already deemed risky enough to have insurance coverage on in the first place. So let's just break this down. The government said, since a given activity is risky, you need to have insurance. That allows the insurance companies to charge a premium based on that risk. Then, when you make a claim based on the risky behavior you had already paid for, they say you're at even greater risk because you filed a claim. Then they charge you more money for that risky behavior they said you needed insurance for in the first place. No. Enough already. It's time a law was enacted that actually protects Americans from this kind of price gouging. And that's why we here at the First Branch have developed the Insurance Policyholders Premium Protection Act. And it's a simple and easy to understand piece of legislation. And here's how it works from the actual language that is written in the proposal. To prevent the insurance companies from the continued practice of double dipping on risk-based payments for monthly premiums, the Insurance Policyholder Premium Protection Act seeks to prevent insurance companies from using claims against the policy by the policyholder to increase monthly premium payments. The scope of this legislation will be for all homeowner-based insurance provisions, all automotive provisions with a motor of 50 cc's or that same power rating equivalent or higher, all aircraft or rotorcraft vehicles, as well as watercraft vehicles. This protection extends to insurance for personal or commercial use. If the activity is deemed risky enough to require insurance, then the risk should be borne by both the insurance company as well as the policyholder. Now let's talk about the protections that this bill provides for both the insurance companies as well as the policyholder. The first one, this bill does not authorize Congress to set coverage rates for the standard 8 basic forms of homeowners insurance, the examples being HO-1 through HO-8. Congress will have no authority to set coverage rates for any private or public insurance provider for either personal or commercial coverage. Number 2, once the monthly premium price is agreed upon, then that becomes the set price for the duration of the contract with that policyholder. Number 3, when the policy expires and the policyholder seeks to renew their insurance with that same insurance company, any previous claims against that policy may not be used as justification to increase the premium price on that contract. An increase in premium prices must be justified across the activity nationwide. The increase in the new premium price may not exceed 5% greater than that of the increase in claims over the previous 24 calendar months of the effective date of the policy. Number 4, insurance companies may not share accident information to other insurance companies when a policyholder wishes to switch insurance providers. Number 5, insurance companies are prohibited from inquiring as to the claims history of a new applicant. This is based on the idea that the associated activity is already a risky one. The company has just as much responsibility to care for its contracts as the policyholder. They, after all, have chosen to participate and make money in this industry. I'm all for these companies making money. They just don't get the right to gouge the American people in the process. Again, this is not a complicated law. It doesn't take hundreds of pages of legal jargon to give weight to legislation. It just needs to provide the intended protection while ensuring efficiency of the industry. So we've already seen how this bill provides protections. So how is it efficient? Again, this is through the shared percentage rule. It's the same rule we presented with the Affordable Health Care Premium Act. This law shares the risk among all entities involved. And how it does this is through the free market. With larger companies prevented from double dipping, smaller insurance companies will now be able to compete for the same market share. This is going to drive prices down in larger markets, like automobile and homeowner and renters insurance. Smaller markets like the aviation industry are going to see very little effect. The fact that the aviation industry itself has seen an increase in accidents, it's already forced higher premiums across that market. So there you have it, America. A simple yet focused solution to the industry practice of double dipping on risk by insurance companies. This is a huge step in reversing the trend of big government regulations protecting industry and overburdening its citizens. Again, we here at the First Branch are working to build legislation to send to our representatives. So Roger Williams has already been sent a copy of this proposed legislation. You can download your copy to send to your representative by clicking the link below in the description with the title of the bill. Also, links have been provided to contact your U.S. representatives as well as your senators. The only way we are going to affect change is to show Congress we are serious about how we wish to be governed. Here's another chance to exercise the will of the people. So please, like and share this video with like-minded conservatives who have a desire to see real conservative legislation enacted to reverse the trends of socialism in this country. Thank you again for carving out time from your busy schedules to watch this episode. I thank you again for your efforts and continued support for this channel and what we do here at the First Branch. Have a great weekend, America, and God bless.